Good afternoon and welcome to the webinar on introductory course Workbook 4. This is a longer presentation and I will go through it as quickly as I can. This presentation deals with the move from private to public sector accounting, and we're going to cover 6 areas within this presentation. First of all, the differences between public and private sector accounting. Secondly, the significance of the public sector budget. Thirdly, budget classification of the chart of accounts. Fourth, cash and accrual accounting. 5, budget execution, and 6, financial reports in the public sector. The first we'll look at is the difference between public and private sector accounting. Fundamentally, the principles are identical. You still will apply double entry whether you're talking about public sector or private sector accounting. It's the institutional differences that matter, and there are certain unique factors leading to significant difference of the practice of accounting in the public as against the private sectors. These are summarized in this table. There are 3 columns in this table. The one on the left is the situation in the private sector entity, in the middle is the same situation in the public sector entity, and then in the final column on the right, the impact of that on accounting. If I take these in sequence, the first one is that the objective of any entity in the private sector is to make money for the owners. And that is simply not the case of the public sector. There are multiple policy goals for entities in the public sector, and accounting is driven by those policy goals. The second difference is that in the private sector, the budget is simply a target. It's got no particular legal significance. Whereas in the public sector, the budget is a legal document for a government enacted by the legislature, and accounting is therefore driven by the budget. Big difference. The third difference is that businesses, a private sector business, is owned by the proprietor, individual owner for a sole trader, partners for a partnership, shareholders for a company. In the public sector, all entities are ultimately owned by the citizens of the country. So there's no capital. Ownership is represented by net equity, which is usually described as a series of funds. Fourth difference is the resources. In a private sector entity, the resources are what the owners put into the business plus borrowings. Public sector entity, citizens don't put money into the country except through taxes, revenues. So the resources are revenues plus borrowed. And those revenues and borrowings are managed through your fiscal policy of the country. There's a profit and loss account for private sector entities. In the public sector, there is no concept of profit, and therefore you have a statement of financial performance, or it's sometimes called a statement of operations, instead of a profit and loss account. In the private sector, profitability measures performance. Whereas in the public sector, there is no simple measurement of performance, and in fact, measuring performance in the public sector is difficult. In the private sector, companies fail, they go into liquidation, they're wound up, and they become insolvent, they cease to exist. Public sector entities in general do not cease to exist, even if they become insolvent. So if a country cannot repay its debts, the country still exists. If, in the example in the workbook, Chicago, as did happen, was unable to pay its debts and went into bankruptcy, Chicago still existed as a city. So there's less focus on actual insolvency and more managing cash and debt to minimize financing costs. So those are important differences. And the first one of them was the significance of the budget. We said in the public sector that budgets have legal status. They are enacted by the legislator, by Parliament of a particular country, for a fixed period, usually 1 year, and they limit expenditure for that budget period. They say how much can be spent under different heads for the budget period. If it's not spent within the budget period, if a Ministry of Health does not use its budget appropriation, then it lapses. By lapsing, we mean that the funds cease to be available at the end of the year. They're not automatically carried forward. This is another problem for public sector accounting and budgeting, which we will look at more later. But budgets are almost invariably cash-based in the public sector. An exception is the UK, which has an accrual budget, but it is unusual. Even where companies use accrual accounting, almost all countries use cash-based budgets. Budget appropriate resources to government organisations. That's the term again that we use. When we say appropriate resources, we mean that the budget will have a sum of money which is the amount of money that is available to that government organisation for the budget year. And this is referred to as appropriating resources. Therefore, the budget presentation will be, in general, based on the government organisation, and you'll have further analysis by economic, functional, and possibly programme classifications. Besides expenditure, budgets also authorise raising revenues. They're often fixed tax rates, for example, and they will plan borrowings. They don't fix borrowings because borrowing is effectively the balancing item between the amount of revenue that you actually raise and the amount of expenditure that you incur. So governments plan borrowings. And if we look at the linkage between the budget and accounting, we can see it in this diagram. As we've said, the budget appropriates funds for expenditure, authorises revenues, plans borrowings. Budget execution manages the implementation of the budget, which is then recorded in the accounting system. So accounting records budget execution, which is then reported in the form of financial reports comparing in some way the budgeted with the actual outturned. And because of that comparison that we have in the reporting, you need a common classification and valuation system to enable management and reporting of outturn against budget plan. We'll talk about that more in a moment. Our third heading is budget classification and the chart of accounts. Now, we've mentioned this briefly in the context of budgets. We'll now look at it a bit more. As we said there, that budgets will normally appropriate funds according to the organisational structure of government, for example, the ministries. Budgets will also normally show a breakdown of that appropriation in terms of major economic categories, that is to say, types of expenditure, for example, salaries, expenditure on maintenance of equipment, and so on. And the third way that budgets will generally analyse the expenditure is by function. If we look at examples from Somaliland 2015 budget, and this is a summary that's been issued by the Ministry of Finance, we can get an idea of what we mean by these three categories. The first one is analysis by organisation. Now, this is a very high-level analysis. You'd obviously need some analysis of, say, central government to ministries, but at a very high level, it shows an analysis between the major organisational groups, central government, autonomous agencies, local governments, the Somaliland Development Fund. That's an organisational classification at a very high level. The economic classification of the 2015 government expenditure shows it being divided between salaries and wages, service expenses, development, support expenditure, and loans. And we don't need to go into what those terms mean in detail. It is important to notice they don't coincide with the IMF specified classification structure, but they serve to illustrate what we mean by an economic classification. The third category is functional classification. Functions may well coincide with organisational classification classifications. For example, one functional category is health, which will normally be responsibilities of the Ministry of Health, but not always. Sometimes those responsibilities might be divided between two ministries. So you might have one dealing, for example, with primary health care and other dealing with all further healthcare expenditures. The functional classification is in fact a standard classification. Now this example from Somaliland does not comply with the standard classification structure, but the UN has issued a standard classification of the functions of government, which is expected to be followed by all countries so as to enable international comparison. And one of the advantages of having a functional classification as against an organizational classification is that functions are static, whereas responsibilities can be reassigned between ministries from time to time. So although the functional classification may look similar to an organizational classification, it is different, and what should be adopted is this international structure as specified by the UN and the IMF. Now, we've looked at 3 dimensions of budget classification. In fact, there are 5 that you may come across. The administrative structure, the government organizational structure, which is obvious. Economic, we've just looked at. Functional, we've just looked at. Program, this would be where a country has a system of programs with specified outcomes. For example, there might be a program of road modernization, and then you would have a program classification of all expenditure associated with that road modernization program, so that you can compare the expenditure with the outturn, how many miles of road you updated, for example. Financing just tries to show where particular expenditure is funded from a particular source. Particularly useful if you've got a lot of expenditure funded by different donors and you want to identify which one is funding what. So those are the 5 normal classification dimensions that you will come across. There are certain standards for classification. The IMF Government Financial Statistics Manuals provided standard functional and economic classification based on UN standards and used for inter-country comparisons. We will look later on in this course at International Public Sector Accounting Standards, IPSAS, but note at this stage that they do not prescribe classification. There is no explicit classification structure as part of IPSAS, but there's an implicit classification structure to enable IPSAS compliant financial reports. In other words, you must have the accounts to enable you to analyze expenditure to the heads under which you are required to report under IPSAS. Now, we've talked about budget classification. Budget classification is the format for presenting the budget, and it's therefore the basis for budget management. The chart of accounts is the ledger account structure of a country, the accounting structure, which is used to record and analyze income and expenditure. But that's got to link back to the budget, because you've got to monitor the actual outturn against the budget plan. And if we look at this diagrammatically, we can see the budget classification with its 5 possible dimensions, linking to a chart of accounts with a similar 5 dimensions. And those should be identical to enable monitoring, management and reporting. In the chart of accounts, you'll need additional codes for your assets and liabilities, because budgets only predict flows, they do not predict balances. So you need codes for your balances, your assets and liabilities within your chart of accounts. So the chart of accounts is driven by the budget. That's difficult if the budget is cash-based and accounting is accrual-based. Now, we're not going to get into that in this introductory course. It's something you'll study later on. But just note at this stage that it is a problem. And also note the chart of accounts will need additional codes for assets and liabilities. If you're using cash accounting, that's just cash. But if you're using accrual accounting, it's all your other assets and liabilities. And note also that this idea of having multiple classification dimensions, possibly as many as 5 classification dimensions, is only feasible with a computerized accounting system. It is simply not feasible to do this with a manual system. Okay, so let's go to the fourth point, cash and accrual accounting. As its name implies, cash accounting records only cash flows and balances. Cash is broadly defined to include notes and coins, bank accounts, and very short-term liquid investments. You do not record flows of other assets under cash accounting. So you don't show flows of liabilities, you don't show flows of assets other than cash. They're simply not recorded. And there is no balance sheet which shows those. Whereas accrual accounting records flows and balances of all assets and liabilities of an entity. So accrual accounting is obviously a much more comprehensive system. Now, this is just some examples of cash reporting. I'm not going to go into these in any detail. They're in your workbook. A cash report, one example is a cash flow statement, which you've already seen for Ahmed. But more commonly, this is referred to as a statement of receipts and payments. On the right, you've got a statement of receipts and payments again for Ahmed with the same information, but reorganized in the standard cash flow format. So there's no difference between the figures in these two. It's simply a matter of reorganizing the information. You still have double entry under cash accounting, but it's very simple double entry. Basically, there's only 2 types of transactions you need to be concerned about. When you make a payment, it's an expense, and you charge it to an expense account, and the credit goes to one of your bank accounts. If you receive money, it goes into one of your bank accounts, and the other side of the entry is the amount of income you received going into income account, for example, taxes. And that's it. So under cash accounting, the only asset is cash, which is defined to include, remember, cash in hand, bank accounts, and short-term, highly liquid investments. And double entry is a simplified form of double entry. Despite its limitations, many, in fact probably most governments, still use cash accounting. Somaliland uses cash accounting. The USA uses cash accounting for central government. Why? Well, cash accounting is much simpler and more intuitive. We've seen how simple it is, the last example. It's more intuitive. Most people find it very easy to understand that money in is revenue and money out is expenditure. Also, your fiscal management is based on the flow of cash, the flow of money in and out of the government, and the balances the government has. So it's the basic source of information for fiscal management. And finally, changing from cash to accrual accounting is complex. I see we've got a question on how you do this, and I'm not going to go into this because it's outside the scope of the introductory course, but we can say that it's a long and complex process and requires considerable skilled resources. What is common, however, is to modify cash accounting in various ways, and so you get what is called modified cash accounting. The reasons are, well, you need some asset and liability accounts. You've got to keep a track of advances and deposits. Advances, say, for travel expenses. Deposits, where you've got to make an advance payment in respect of some service you're going to receive. These are often called below-the-line accounts because if you think of the budget as recording flows, you then draw a line underneath it and you show these additional accounts of certain assets and liabilities. So they're not part of the budget, they're below the line. Other examples, salary deductions are sometimes expensed under cash accounting, although there's actually no cash payment. And also quite often the accounts are kept open for a period, perhaps a month after the end of the year, so that checks written in that period for payments are treated as belonging to the year. So checks written in January 2017 might be treated as part of the 2000 cash expenditure. And that takes us on to budget execution. Budget execution is the implementation of the budget. It involves collecting revenues in, making expenditure payments in accordance with government activities of the budget, and then the management of cash and borrowings. It's the stage at which you put the budget into operation. And there are three major requirements for a good budget execution system. First of all, it should make the funds available when required. If you have got an ongoing project which needs regular funding, you don't want a delay of several months while you wait for the money to come through. So you have to make sure that funds are available when they're required for your operations, and you want to do it as cheaply as possible. There is obviously a balance between the costs of control and minimizing transaction costs. The second requirement is control. Control to ensure that expenditures are within the budget limits and for the purpose intended. And finally, a monitoring system to track the above, to provide information on committed and actual expenditures against the budget. And this brings us on to the concept of commitments. A commitment is a legal undertaking by an entity to incur future expenditure for a specified purpose. And we can see that if we look at the examples of a short-term and a long-term commitment. A short-term commitment would be, for example, an order to supply goods. When you place the order, you're making a commitment to pay for those goods when you receive them. At this stage, it's not entered in the accounts because you haven't received the goods or a bill, yet alone paid for them. But you have legally committed yourself to receiving those goods when available. And you can also have long-term commitments, for example, a construction contract extending over a number of years. And that's got important implications for the budget, because once you make a commitment, those funds are no longer available to spend on anything else. And that doesn't just apply to the current year. If it's a long-term contract, that will apply to all future years. So in each year, there is a reduction in the funds that are available for other purposes. If we take this very simple example of a ministry, let's say, which has a budget as indicated on the left, 500, 550 and 600 for years 1, 2 and 3, a commitment to buy drugs which will be supplied by a certain party each year for the next 3 years. So an advance commitment for the purchase of drugs, which reduces the amount of budget that is available for other purposes. So in your budget planning and budget management, you must know about commitments. You don't wait until you get the bill in. You need to know when the order is placed and the commitment made. So the flow is from the amount appropriated in the budget, the commitment when the order is placed, the liability when the goods are received, and the cash flow when payment is made. A simple method of controlling this is the vote ledger. Now, the vote ledger is not part of your books of accounts. It's a separate memorandum record to help management, and it uses information from the accounts. The best way to explain it is to look at an example. This is the one in your workbook. Supposing that you plan to buy a new vehicle for a particular ministry and you have a budget authorized for that purpose of $20,000. But when you come to place the order for the vehicle, it's less than you budgeted. You can get one for $15,000. When you place that order, you made a commitment. The vehicle is delivered and an invoice received for $15,000, which is then paid 30 days later. So this is what the vote ledger looks like. The column on the left is the budget code, whatever it happens to be. It's just the number that is used in the classification system to find that particular head of expenditure. The description is motor vehicles. On January the 1st, you have a budget appropriation of $20,000 for motor vehicles, and therefore that amount of money is available. On February the 15th, you order your new motor vehicle at a cost of $15,000. Now that isn't an actual liability because you haven't received the vehicle. You've simply placed an order. But you do need to record that commitment because it reduces the budget available for other purposes from $20,000 to $5,000. On April the 1st, you receive the vehicle and a bill. That's no longer a commitment, that's now a liability. Just pause on that one. Once you receive the vehicle and you are billed for it, you have now got a liability to pay for that vehicle. So you've got to take it out of commitments and put it into your liabilities, assuming you've got accrual accounting. And then finally on the 30th of April, you pay $515,000. Don't know why you paid more than you're quoted, but anyway, you pay $515,000. Sorry, you pay $15,000 for the vehicle. $15,000 for the vehicle. Now, all the way through, once you made the commitment, the budget is reduced by $15,000. It doesn't change whether it's a commitment, a liability, or a cash payment. Once that money is committed, it's no longer available in the budget. If you are using accrual accounting, the actual expenditure occurs when you receive the vehicle and the invoice. If you're using cash accounting, you treat the expenditure as being incurred when cash is paid. You can use the vote ledger for either system, just that the liability emerges at a different point in time. Now that brings us on to another issue of budget management, which is virements. Virements is the technical term for a budget transfer, a transfer between budget heads. And you use it to adjust overspends under one budget head and underspends under another budget head. Virements will normally be controlled by legislation and or financial rules of a particular country. And virements must be recorded. So this is another feature of your accounting system. It needs to record transfers between budget heads, something that a commercial system will not normally do. Look at the example that we've just had. $20,000 was the budget for motor vehicles. We only spent $15,000 on the car, so we've got an underspend of $5,000. On the other hand, perhaps computers, which had a budget of $12,000, has got an overspend of $5,000. It's actually spent $17,000. So what you want to do is to transfer $5,000 from your motor vehicle budget into your computer budget, decreasing your motor vehicle budget to $15,000 and increasing your computer budget to $17,000. That transfer is a virement. Finally, we're going to look at reporting. Financial reports are the outputs of the accounting system. They're the product of your system. And there are two types of reports: internal management financial reports and external financial reports. Internal reports are used by the management for the better management of the particular entity. And at the moment we're not going to look at those. We shall concentrate on external financial reports. These are reports that should be publicly available and audited. And they serve a number of purposes. They, first of all, provide information on budget integrity. Has the budget been observed? Has expenditure been made as planned in the budget? Secondly, operating performance. Now, as we've said, measuring performance in the public sector is very difficult, but part of that must always be the amount of money you spend on something. So you need financial reports to give you that information. Thirdly, fiscal sustainability. How much has the government borrowed? Is it sustainable? Is the government over-borrowing? This will come information available from the financial reports. Stewardship. The government controls assets and liabilities of the country, of the citizens. How well has it undertaken that role? It's stewardship of those resources. And finally, the financial reports provide an indication of the effectiveness of the systems and control over public money, both revenues and expenditure. So those are the purposes of financial reports. The principles of reports are in this list. Most of them are common sense. The budget must be complete. It must include all of the revenues and expenditures of government. Now that's often a problem. In many countries there are items which are kept off budget. But the principle is that the budget should cover all revenues and all expenditures. Legitimacy. The information provided in the financial reports and made available should be information to which the users are legitimately entitled. The report should be presented in a way that is user-friendly. They won't be read by professional accountants. They will be read by ordinary citizens of the country. So they should be user-friendly. They should be reliable, not necessarily accurate down to the individual cent, but they should be reliable in that the information in them can be relied on, and also should be relevant, not a lot of irrelevant information. It should be presented consistently from one period to another. It should be presented in good time. You don't want your accounts 3 years after the end of the financial year. You want them within 6 months, preferably sooner. There should be comparability from year to year, so you shouldn't keep on changing the way you present information, making comparisons difficult. It should be consistent over a period of time. And it should be useful. Government debt is really a principle of reporting. It's just something that you should have in your reports, is you should normally show information on government debt. Financial reporting standards. There are actually two sets of standards on public sector financial reporting. The one is provided by, let's go back a bit. First of all, let's talk about private and public sector. Private sector financial reporting is by the International Financial Reporting Standards, IFRS. Public sector is by the International Public Sector Accounting Standards, IPSAS. We are concerned with IPSAS. We're not concerned with IFRS. And IPSAS divided into two. There is one cash basis IPSAS, which applies to all entities reporting under the cash basis. And do note that there is a new cash basis standard expected to be issued in late 2017. Obviously you're being examined on the existing one, but you should be aware that there is a new cash basis standard coming out. And then there's the accrual IPSAS. We say 40. There are IPSAS 1 to 40, but actually 3 have been withdrawn. So there are 37 that are currently in issue. They apply to entities reporting under the accrual basis, and do notice they are being constantly added to and revised. The information in this workbook is based on the situation as of today. But possibly by the end of the year, there will be some additional or changed accrual IPSAS. Now, we've talked about IFRS and IPSAS. IPSAS apply to entities that meet three criteria, three requirements, and all three must be met. First of all, the entity must be responsible for the deliveries of services to the benefit of the public and or to redistribute income and wealth. Essentially, that means that the entity must be one which delivers services in some form. A government, a ministry, a hospital, a school. They all deliver services and meet that criteria. Secondly, they mainly finance their activities by means of taxes and transfers. A school may charge fees to students, but unless that's the major part of its income, it meets this requirement. So most schools charge fees, but they're just a minor part of their income. Most of the financing of schools comes from central government and therefore eventually from taxes in some form or other. And the third requirement is the entity must not have a primary objective of making profits. So put very simply, IPSAS apply to not-for-profit entities controlled by central government, controlled by government, any level of government. Anything else applies IFRS. Now, under the cash basis standards, the content, there are three documents which are the contents of the financial report. The first one is a statement of cash payments and receipts. I'm not going to read out all the criteria. And the second one I wouldn't worry about because it's going to be removed almost certainly in the revisions to the cash basis standard. So the main thing is that it should be a record of your cash receipts, cash payments, and cash balances. There should also be a statement of accounting policies and any explanatory notes. And finally, you should provide a comparison of the budget and the actual amount spent. Now, you could incorporate that in your statement of cash receipts and payments, or it could be a separate document. The discretion is left to you. This is a statement of receipts and payments in a simple horizontal format. Excuse me. That meets those requirements. It shows the receipts, it shows the payments, it shows the opening balance, the surplus of cash receipts over payments for the year, and the balance at the end of the year. You could analyze it in greater detail, but that meets the requirements. Very simple document. Accrual financial statements are much more complex. Now, in the introductory course, we are not going to get deeply involved in accrual financial statements, but you should know what are the contents of accrual financial statements. And there are 6 documents. A statement of financial position. That's a balance sheet. So it's a new term, but it means exactly the same as a balance sheet. A statement of financial performance, which would be a profit and loss account in a commercial entity because you're not making a profit. It is referred to as a statement of financial performance. A statement of changes in net assets, equity, I won't get into that. It does just show how your assets and equities have changed. A cash flow statement, which we've already seen. Again, a comparison of budget and actual. And your notes, which include accountancy policy and other notes explaining items in the main financial statements. So 6 documents in your accrual financial statements compared to the 3 of the cash basis. As we say, there are currently 37 accrual IPSAS. There is a list in your workbook. Do note you are not expected to memorize the list of IPSAS. It's useful to have it and to refer to it, but you're not expected to memorize it. And finally, we've got an example of accrual IPSAS compliant financial statements. Again, not something we're going to get into too much in the introductory course, but just so you can see what they would look like. So the statement of financial performance, remember the equivalent of the profit and loss account, but instead of a profit or a loss, you have an operating surplus. If it was negative, it would be an operating deficit for the year, which shows the excess of receipts over expenses. You have a statement of financial position, which is the balance sheet, which is just like a private sector balance sheet, except for the description of capital, which is now replaced by equity, or net assets, whatever you want to call it, or you could use the term funds, where you've got the opening balance, the surplus from the year, and the net equity at the end of the year. The cash flow statement, which is the format that we looked at with Ahmed, but more information. I'm not going to go into the comparison with budget at this stage, nor am I going to go into the accounting policies and notes. So, we have now covered all 6 areas. We've looked at moving from commercial to public sector accounting. We've looked at the differences between public and private sector financial management, the significance of the public sector budget, budget classification and the chart of accounts, cash and accrual accounting, budget execution, and reporting. And finally, I've just got a few questions which I will just comment on. Difference between cash basis and modified cash basis. Well, we've seen that in one of these slides. We looked at the modifications that are commonly made to the cash basis. Managing arrears under the cash basis accounting. The cash basis accounting does not manage arrears. You need to set up a separate manual system to manage arrears. Responsibility for budget departments will normally be specified in the legislation. And finally, the move from cash to accrual accounting is a really big subject area. I'm not going to get into that. There is an article which we've just published in the International Journal of Government Financial Management on modernisation of financial reporting, and I'll send you a link to that. Okay, thank you very much.